15 years ago, the federal government had to intervene with controversial bailouts to stop a potential depression this country hasn't seen since the 1930s. People talk about 2008 like it's all over and we've learned our lesson, but the housing market is in a worse bubble than ever before. When it bursts, it's going to be catastrophic. Here's how we know. Let's start by looking at a chart of home prices over the last 80 years and compare the prices before 2008 with the prices today. Except, wait, we can't use this. Of course, we need to account for inflation. Inflation is a measurement of how the purchase power of the dollar decreases over time. As your grandpa has probably told you, a dollar just doesn't buy what it used to. Inflation is a normal process, but when it moves too fast, it can be a sign of a recession. However, we're trying to compare house prices. Without inflation, house prices should stay fairly stable over time, rising only slightly as time goes on. So when we adjust for inflation, we get something called the adjusted real house prices. What did that look like before 2008, and what does it look like now? Even if you account for inflation, home prices have still skyrocketed. In fact, we've surpassed the peak of the bubble before the 2008 crash. Houses are even less affordable and prices are even more inflated than when they were at that time. Some increase in real home prices is to be expected over time, but as you can see, this kind of peak we're seeing is crazy. It even looks wild compared to the peak before 2008. This means when the market finally does adjust, and it will adjust big time, it's going to be a huge drop. People who have multi-million-dollar houses in their net worth will suddenly have a house worth 10 times less. It's one big reason we predict this housing crash will be even worse. The distance back to normal is much bigger. Imagine that someone had $10 million invested in real estate in 2007. The bubble burst, the market crashed, and house prices dropped big time. In California, housing prices dropped 35% in 2008. That means that investor started the year with $10 million in real estate assets and ended the year with $7.5 million. Home prices are even more inflated, so we're looking at an even bigger drop to adjust. Some analysts even predict a 50% drop when we hit the recession, although that is estimated worst-case scenario. If that's the drop we're looking at, that means that $10 million in assets will suddenly be $5 million. Even if the drop isn't that high, it still definitely will be more than a loss than what happened in 2008 and the following recession. When the bubble bursts, a lot of people are going to lose a lot of money. That kind of loss will have ripple effects across the entire economy. There is more evidence that we're headed for a bigger bubble burst than we've seen in almost 100 years. Let's take a look at how long housing prices have been rising. Before the 90s, the housing market would only rise for about 3 to 7 years before taking a dip that normalized prices once again. But what happened before 2008? The market rose steadily for longer than it had before, for about a decade. Then it, basically exploded and fell off a cliff. This time, we've been cranking our way up that roller coaster even longer than last time. It's been over a decade now since the market had a real dip. We've been going up, and up, but what goes up must come down, and the longer we go up, the harder we'll fall. Why have house prices been increasing so much for so long? There are several reasons, but there's one big primary reason the market doesn't correct gently like it used to. Let's dive into one of the primary causes of the bubble that's about to pop. The real estate market has a large segment of purchasers that are artificially driving up demand by grabbing houses they won't live in, or in some cases even rent out. These are the speculative buyers, the investors who have the purchasing power to grab houses quickly, knocking residential buyers out of the market. On average, about a quarter of all homes in the US are owned by some kind of investment group, not individuals. In some states, particularly the ones that are booming real estate markets, as many as 30% of homes are owned by speculators and investors. This trend of investment firms jumping into the market actually began in 2009 in the aftermath of that housing crisis. Companies took advantage of the many foreclosures to buy up a big chunk of housing for the first time. Corporations had always invested in real estate, but the difference here was the investment in single-family dwellings. Before this, investment was focused on multi-family dwellings like apartments that are commonly rent generators or commercial properties. This same trend took off once again during the pandemic. From 2020 to 2021, the number of homes owned by investors increased by over 80%. What does this tell us? That at the same time most people were desperately struggling to not get evicted, companies were gobbling up newly foreclosed homes. We have an image that most of these buyers are massive, faceless mega conglomerates, but that's not exactly accurate. For the most part, these real estate investors are smaller hedge funds or real estate investment trusts or things of that nature. But even though it's not World Domination Inc. buying these houses, it still means fewer homes are available for purchase by individuals looking to buy their own residence. While this may seem like a normal byproduct of a functioning capitalist economy, after all, what do we expect those hedge funds to do with all that money they've got lying around? It does have negative consequences for the housing market. Why is it a problem? Because of the most basic law of economics. Supply and demand. This law is pretty simple. Price is a function of where the supply and demand curves meet. If supply goes up, prices go down. If supply goes down, prices will go up because the thing being sold now is more rare and therefore more valuable. For demand, everything is reversed. If demand goes down, prices will go down because people don't want to buy the thing that badly. And if demand goes up, the prices will go up. Obviously, in both the real world and the economist's chalkboard, this simple formula gets much more complicated very quickly. But it is the fundamental law that we use to understand the fluctuations of supply, demand, and price. When companies enter the arena, they artificially raise demand. Even though people don't really want all those houses, this causes the prices to go up. Let's say we have 100 houses for sale and 100 families looking to buy a home. Awesome, perfect alignment of supply and demand. But what if a company steps in wanting to buy homes too? This company has much more money than these families will ever have, and they want to buy 50 homes. They will surely outbid the individuals and buy the homes. Now we have 50 homes remaining for the 100 families to bid for. Prices will skyrocket because even though only 100 families really want homes, there are 150 units needed. Then, when the dust settles, 50 families will be priced out of the market. And where do they get to live? In the homes purchased by the corporation, if the corporation decides to rent them out at all. This is obviously a simplified example, but it happens all the time in the real world. Companies head into booming real estate markets, sensing opportunity, buy up large numbers of homes, and leave less on the table for the individual home buyers. Prices rise accordingly, as demand seems to outstrip supply. Another problem is that speculators tend to focus on starter homes rather than larger houses. This means they are buying up what would have been cheaper real estate. This raises the price for smaller houses and makes the minimum required investment to become a homeowner rise considerably. Anybody who has taken a peek at a 2-bedroom house on Zillow, especially in popular markets like California, can see that. There are some who even claim that companies are profiting off buying homes and leaving them vacant. How does this work? By buying the house and taking it off the market, they are effectively shrinking supply, driving up the price to meet demand on the curve. If you do it on a large enough scale and drive up prices enough, it can certainly mean big profits. This might seem strange, but when you think about the estimated 1.2 million homes sitting empty in California, which is 8.7% of the total homes, you might see the logic. Why are all those homes vacant when there is an estimated 1.8 million housing unit deficit? Many of those homes have been vacant for a very long time with no attempt to sell them. In some cities, entire apartment complexes are left vacant to drive up prices in the area by simulating a decreased supply. With house prices so inflated and a huge chunk of housing supply simply sitting on the sidelines, our supply and demand curves are hugely messed up. But you can only outrun the law for so long. And since all the factors that contributed to the 2008 crises are here, and are even worse than they were 15 years ago, when the correction comes, it's likely going to be the worst we've seen in almost a century. Buckle up, because when the coaster drops, it's going to be a bumpy ride.